Most people do not realize they are paying too much tax for a very simple reason. They are paying for life with after-tax dollars when the tax code, used properly and legally, often lets a business owner pay for large parts of life with pre-tax dollars instead. That single distinction changes everything. It is the difference between earning $10, handing $3 to the government first, and trying to survive on what is left, versus deducting legitimate business expenses first and only paying tax on the remainder. That is not some loophole whispered in a back room. That is the architecture of the code. And once you understand that architecture, you stop looking at taxes as some fixed punishment that descends from the sky and start seeing them for what they really are. A set of rules that reward certain behavior, rules that punish other behavior, rules that most people never study deeply enough to use in their own favor. Now let me say this at the start because it matters. I am not talking about cheating. I am not talking about pretending your beach vacation was a board meeting because you answered one email by the pool. I am not talking about playing games with receipts or inventing a business out of thin air just because you want to feel clever. That is not strategy. That is stupidity with documentation. What I am talking about is legal, ethical, technically supported tax planning built around a principle that has existed in plain sight for a very long time. If you operate a trade or business, and if an expense is ordinary and necessary to that business, the tax code often allows you to deduct it. That is the core principle. Simple enough to say, harder to apply properly. And because people do not understand how much of modern life can intersect with that principle when a real business is present, they miss deductions constantly. Housing, vehicles, meals, travel, medical expenses, health insurance, your children, your parents, education. It sounds absurd the first time you hear it. Then you study the rules. Then you realize the absurd thing is not that these costs can sometimes be deducted. The absurd thing is how many people pay for them inefficiently for years because nobody ever showed them how the system actually works. So let me begin with the fundamental mindset shift, because without that, the rest of this becomes a list of tactics instead of a coherent way of thinking. Most people earn money personally first, then they pay tax, then they use what remains to fund the rest of life. That is the normal pattern. Salary comes in, government takes its piece, then you pay for housing, transportation, insurance, childcare, education, medical costs, and all the rest out of what survived the first round. That feels normal because it is common. Common is not the same as optimal. The more sophisticated people understand a different sequence. They create or operate income that qualifies as trade or business income. Then the business pays for legitimate business expenses or reimburses certain qualifying costs. Then only what remains after those deductions becomes taxable income. Same economy, same money, different order of operations. That order matters enormously because taxes are not a flat annoyance layered on top of life. Taxes are a function of taxable income. Reduce the taxable income legally and you reduce the tax. It is arithmetic before it is politics. Now, the heart of the whole thing sits in a principle many people have never actually read for themselves. The concept that a taxpayer carrying on a trade or business can deduct ordinary and necessary expenses paid or incurred in that business. There is a lot packed into those words, so let me break them down the way I think about them. Ordinary means normal for the kind of business you run. Necessary does not mean life or death necessary. It generally means appropriate and helpful trade, or business means you are actually operating something with the intent to earn income, not merely entertaining yourself with the costume of a business. That last part is where many people either underestimate their eligibility or overestimate it. Some people assume they need a fancy office, an LLC, employees, branding, and a storefront before they are allowed to think like a business. Not true. A side gig can qualify, a 1099 contracting arrangement can qualify, affiliate income can qualify, creative work can qualify, day trading in some cases may be argued differently depending on how it is conducted. But people certainly talk about it in this framework. Rental activity can create business-related planning opportunities depending on structure and involvement. DoorDash consulting, coaching, freelance work, online commerce, a small service operation, a content business. You do not need a marble lobby, you need actual income activity and a real business purpose. That is the doorway. Once you step through that doorway, a lot of expenses people thought were forever personal begin to look different. Not all of them, not automatically, but differently enough that it changes how you organize your life. Now let us start with the biggest category most people have, because if you can understand this one, the rest of the framework starts feeling much more practical. Your home. Most people think of their home as either entirely personal or entirely irrelevant to tax planning unless they sell it someday. That is shallow thinking. If you use part of your home regularly and exclusively for business, the home becomes partially business property in the eyes of the rules. Those two words matter: regularly, exclusively. This is not where you say, I answer emails from the kitchen. Therefore, the whole house is a deduction. Number that is not how grown ups do this. If you have a room, a dedicated office, a specific area used only for the business, then now you are talking a home office, a room where you run operations, a basement area dedicated to inventory or product work, a garage used to store business materials or conduct qualified work. A defined area with a real business function. Once that exists, you may be able to allocate a portion of broader home expenses to the business, based on the percentage of the home used for that purpose. That means the deduction is not just some symbolic write off of a desk lamp. It can reach into rent or mortgage-related costs, utilities, internet maintenance, and other expenses tied to keeping the whole property functioning. This is where people wake up, because they realize the tax code is not always focused on how something sounds emotionally. It is focused on use. If 10% of the home is legitimately used in the business, then 10% of certain home costs may become business deductions. If the home costs $50,000 a year to maintain in the qualified business, use area is 10%, then now you are talking about a deduction tied to $5,000 of cost. Change the numbers and the deduction changes with them. That is not magic. That is apportionment. And apportionment is one of the most valuable tax planning concepts ordinary people ignore. Now, can you do more with a home than simply claim a home office? Of course. The source material points toward other strategies people talk about, such as renting your home to the business under specific rules or shifting the entire property into a different economic use that unlocks other categories of deduction like depreciation. Those strategies are more technical, more sensitive, and absolutely the kind of thing where you want real guidance because structure matters tremendously. But the broad point remains: your home is not automatically tax dead. If your business genuinely uses it, part of its cost structure may become tax relevant. Now let us move to the next everyday expense people obsess over: vehicles. This is one of the hottest topics in tax planning because everyone has heard some version of write off your car, and most people either misunderstand it wildly or assume it is all smoke. It is neither. The basic rule is not mysterious. If the vehicle is used for business, then the business use portion may be deductible. That is the center of it. Again, we come back to use and purpose, not fantasy, not vibes, not because you like the truck and want the government to help pay for it. There must be a legitimate business reason for how the vehicle is being used in your trade or business, meeting clients, traveling to business locations, delivering products, performing services, going between business sites, doing things that actually tie to the income activity. Solve that first. Without business use, the conversation is over. Once you solve that, then the law opens two broad ways of thinking: actual expenses, or mileage. Base deduction. Actual expenses pull you into depreciation, fuel, repairs, insurance, and the other real costs of ownership allocated to business use. Mileage gives you a fixed write off per business mile driven under the applicable rate structure. Which method is better depends on the situation. I do not worship one over the other abstractly. I ask which one fits the economics and the facts. Now, the source material also notes a bigger lever. If the vehicle is used more than 50% for business, it may qualify for more aggressive treatment under the bonus depreciation rules being discussed there. That is one reason vehicle planning gets so much attention. The tax impact can become material fast, but again, I refuse to romanticize it because this is where people get reckless. You do not start with the deduction and work backward to invent the business use. You start with the real business use and then see what deduction the facts support. That distinction protects you. Now let us move to something people spend money on all the time and almost never think about correctly: meals. This is another area where the folklore is everywhere and the actual rule is usually more disciplined than the myths. A meal is not deductible because you are hungry and you happen to own a business. A meal becomes interesting when there is a business purpose and a business contact present. That is the center of gravity. The meal exists in the context of a business discussion, a client relationship, an employee matter, a partner conversation, a prospective opportunity, or some other business interested interaction. That is what moves it from consumption to business cost. Now here is where people get uncomfortable because the source material points out something true and awkward The business contact does not have to be a stranger in a suit to count as a real business-related participant. Sometimes people structure legitimate involvement with close friends or family members inside their business life. If the affiliation is real and the purpose is real, the deduction conversation changes. That surprises people because they think the rulebook is emotionally judging the social arrangement. It usually is not. It is looking at business purpose and business relationship. Still, do not get stupid with this. If your so-called business meal is obviously just dinner with your cousin and no real business relationship exists, then you are not being clever, you are being sloppy. But where the facts are real, meals can absolutely shift from personal to business in a compliant way. Now let me widen that into travel, because this is where the emotional resistance gets even stronger. People here turn your vacation into a deduction and instantly split into two camps. One camp gets too excited and wants to pretend every trip can be magically converted into a write-off. The other camp becomes moralistic and assumes none of it can ever be true. I do not belong to either camp. I belong to the facts. Travel can be deductible if it is really business travel. That means the purpose of the trip is tied to the business and tied to increasing or preserving income activity, attending an event, meeting with relevant people, filming or creating business content, if that is what your business actually does. Looking at investment property or business property, if that truly fits the business. Holding planning meetings, research connected to the operation. Again, purpose is everything. If the trip has a real business reason, then costs like airfare, lodging, transportation, and other travel-related expenses can move into deduction territory. And once people understand that, they start seeing travel differently. Not as a trick, as a category where documentation and purpose turn life cost into business cost. That is the pattern across all of this, not magic reclassification through use. Now let us move into one of the most painful categories in all of personal finance, medical expenses. These costs bankrupt people, terrify people, and in many cases arrive at exactly the moment when the person least has the patience to study tax mechanics, which is why a lot of money gets left on the table here. Yes, there is a path for medical deductions even outside of a business, but it is often clumsy because it generally pushes you toward itemizing and because only the portion above a certain threshold relative to income is relevant. That means many people spend significant out-of-pocket medical dollars and still get little or no tax benefit because the structure of the deduction is too limiting. That is why business-related planning can matter so much. If the business is structured in a way that supports a benefit arrangement, then suddenly expenses that were practically invisible from a tax perspective can become much more visible. The source material points to health reimbursement arrangements, or HRAs, as one route. That is a serious tool, a business reimbursing eligible medical expenses through an approved arrangement changes the tax treatment. What looked personal can become deductible to the business and structured differently for the individual. Now, I am not pretending every person watching this can snap his fingers and drop an HRA into a sole proprietorship over lunch. Entity structure matters, employment relationships matter, the arrangement must actually be set up correctly. This is not casual territory, but the principle is powerful. If medical expenses are large enough, the right structure can change the economics materially. Then there is the HSA conversation, which many more people should understand. A health savings account, when paired with the right kind of health plan, lets you deduct contributions now and use the money tax-free later for qualified health expenses. That is why people sometimes call it one of the most tax-efficient vehicles available. You are effectively saving pre-tax dollars for future medical costs and then spending those dollars tax-free when the costs arrive. That is not exactly the same thing as writing off the expense in the moment through a business. But economically, it can feel very close. And then you have health insurance premiums themselves. This is another area where people regularly leave money behind, simply because they do not know the rule exists. If you are paying for your own health insurance, there may be a deduction path for those premiums, not just for you personally, but also potentially for spouse and dependents, depending on the facts that matters, because these premiums are not trivial. For many families, they are one of the major recurring costs in life. And if that cost can be moved into a deductible channel, the annual tax effect can become very real. I like the source material's practical suggestion here. Paying those costs directly through the business or reimbursing through the business where appropriate can help make sure the expense gets recognized properly rather than disappearing into the chaos of personal spending where it is easier for it to be missed later. Now let us talk about dependents, children, parents, people you support financially. This is where some of the most surprise reactions happen because most people assume support is simply support, and the tax code can do very little for them unless some standard credit applies. That is an incomplete view. One strategy is straightforward enough, though it still requires discipline: hire them. If your dependent can actually perform real work in the business, then paying them wages turns financial support into payroll expense. Payroll expense is deductible to the business. That is the core concept. Now, this is not a license to pay your 7-year-old 6 figures for consulting. The work must be real. The pay must be reasonable. The arrangement must be supportable. But where a spouse, child, or other family member actually works in the business, you have shifted money from one tax environment into another in a way that can benefit the household. The business gets a deduction. The recipient may be in a lower bracket, sometimes much lower. That is not abuse. That is structure. Then there is another route the source material mentions, and this one is particularly interesting for families carrying real care costs. A dependent care assistance plan. Again, this is not casual dinner table planning. It is an actual benefit arrangement that, if established correctly, allows the business to reimburse certain child care or elder care costs up to the allowed limit. The reimbursement may be deductible to the business and tax-free to the recipient when done properly. That is a beautiful sentence when it becomes real life. Why? Because those are expenses people are going to have anyway. And if the business can carry some of that burden through an approved mechanism, then now one of life's heaviest household expenses is being funded more efficiently. That is the entire philosophy here. You are not inventing costs. You are rerouting existing costs through legal structures that reduce tax friction. Now let us move into another category almost everybody spends on in some form. Education. The tax code recognizes something very simple here. A business often requires skill. Skill often requires training. Therefore, the cost of obtaining or maintaining certain business-related skills can be deductible. That is the chain. Now, that begins with the obvious things: courses, seminars, conferences, books, trade publications, programs that deepen or maintain the skills required in the business. Those are not controversial. Most people understand that much. What they often fail to understand is how much farther the logic can go when the facts support it: licenses, certifications, professional requirements. In some cases, even broader higher education expenses when they are directly tied to the existing business and necessary for it. Again, I am not telling you that every random degree becomes deductible because you would like it to be. The education must connect to the trade or business in a way the rules respect. It must maintain or improve skills relevant to the work rather than simply qualify you for a wholly new field disconnected from the current business. That distinction matters. But where the connection exists, the deduction can be substantial. And here again we return to family. If family members are legitimately employed in the business and educational assistance arrangements are set up correctly, the business may have ways to reimburse qualifying education costs in a deductible way. This is how households that understand the system slowly shift huge categories of spending out of the after-tax world and into the pre-tax world. That is the whole pattern, not one trick. A philosophy. The philosophy says this: if you are already paying for something and there is a real business reason for it or a real business structure around it, then the right question is not merely, can I afford this? The right question is, am I paying for this from the most tax-efficient place available under the rules? That question alone can change a household's economics over a decade. Now, I want to address something people do not like hearing, but it matters. None of this works if the business is fake. You cannot drape a costume of business over a purely personal life and expect the tax code to salute. The code is not blind. If there is no income activity, no business purpose, no operational facts, then you are not tax planning. You are fantasizing, and fantasies are expensive when they meet auditors. So I want the principle to be very clear. The business must be real, the purpose must be real, the records must be real, the reimbursements, agreements, and benefit plans must be set up correctly. Once that foundation exists, the deductions can be powerful. Without that foundation, you are standing on cardboard. That is not where I want anyone standing. Now, if you step back and look at everything we just covered, the pattern should hit you all at once. Housing can become partly deductible through qualified business use of the home. Vehicles can become partly deductible through legitimate business use. Meals can become partly deductible when the business purpose and business contact are real. Travel can become deductible when the trip is genuinely tied to the business. Medical expenses can move into better tax treatment through the right arrangements. Health insurance premiums can be captured rather than ignored. Dependents can sometimes be supported more efficiently through employment or benefit structures. Education can become deductible when it genuinely serves the business. That is a large piece of ordinary life, and most people pay for all of it with after-tax dollars because nobody ever sat them down and explained that the tax code is not just a punishment system. It is also an incentive system. It rewards business activity. It rewards structure. It rewards documentation. It rewards people who think before they pay instead of after. That last part matters most. A lot of people do not have a tax problem. They have a timing problem. They wait until the year is over, then ask the accountant to save them. Too late. The money already moved through the wrong channels. The reimbursement plan was never set up. The home office was never formalized. The records were never created. The payroll to the child was never run. The medical strategy was never structured. Tax savings almost always begin before the expense is paid, not after the return is filed. That is why sophisticated people do not just have accountants. They have systems. Now let me leave you with the simplest summary I can give. Most people overpay because they live personally first and tax efficiently second. The people who pay less legally often do the opposite. They build or operate a real business. They understand what the rules allow. They route everyday economic life through structures the code already recognizes. Then they pay tax on what is left. That is not unfair. That is informed. And in a world where most people never learn this, being informed creates a massive advantage. Not because you earn more, because you keep more, and keeping more of what you already earn is one of the cleanest forms of wealth building that exists. You do not need a miracle stock for that. You need understanding. You need discipline. You need real business purpose. And you need the willingness to stop doing what most people do automatically just because it is common. Common is expensive. Structure is powerful. If you operate a trade or business, there is a very good chance you are already paying for things that could be treated far more intelligently. That is the whole point. Not to force every expense into a deduction, to stop missing the deductions that the rules already allow,